Welcome back to Trendlines Over Headlines, the show where we break down the markets with some of the best traders and analysts out there. My guest today is Willie Delwiche of All-Star Charts. Willie is a technical strategist. He does a lot of work on breadth and sentiment, which are two things we've been hearing a lot about lately. So I'm really looking forward to hearing his thoughts. But first, it's Friday, the markets are closed. So let's take a quick look at how this week played out. Hey guys, thank you for watching, and just a quick reminder, if you enjoy the show, be sure to like this video and subscribe to our channel so we can continue bringing you awesome content. Thanks. All right, so all four major indices closed lower this week. The Dow led, but it essentially closed flat on the week. The Russell 2000 lagged, falling nearly 3%. Now, of course, the big story from this week was the 200-day moving average. The S&P 500 kissed it on Tuesday, but it got rejected, and we closed lower by about 2% off those intra-week highs. And to be clear, it wasn't just the 200-day moving average there. You also had the VWAP from the peak, the downtrend line from the peak, the 61.8% Fibonacci retracement of the decline. So there was really a cluster of resistance near that 200-day moving average. And after the 17% rally we've had in the last 2 months, a little bit of pause here shouldn't be a surprise. And at this point, it's perfectly normal as long as we're above those June highs. If we're below those June highs around 4,200, that would constitute a failed breakout. And as we know, out of failed moves come fast moves in the opposite direction. So those June highs are really going to be an important one to watch next week. If we're below there, things could get ugly quick. But at this point, it's really just a retest of those June highs. Now, moving on to the sector performance, staples led with utilities and energy close behind it, while communications underperformed, falling a little over 3%. Now, my next guest, Willie, has a ton of great information and charts to share with us, so let's get to Willie. Willie, thank you for coming on the show today. How are you enjoying these last few months of summer in Milwaukee?
Well, first of all, thanks for having me, Patrick. It's beautiful here in Milwaukee. It's cool nights, warm days. I mean, it's what summer should be. Interesting at the Delwiche household, we've got kids going back to school already, so it's already feeling like we've slipped into September. But market's still open. We still got work to do.
I know. I don't know where the summer went. So the question on everyone's mind right now is, are we in a new bull market, or is this just a bear market rally? And the last time I saw you was towards the end of April. The S&P 500 had just entered into that, bear market. And I put that in air quotes because, everyone has their own way of defining bull and bear markets. And, the media will define it as a 20% fall from all-time highs. And I asked you, I was like, how do you define a bull or bear markets? And you made a really interesting point that I want you to kind of elaborate on, which was it's really all about net new highs. So new highs minus new lows. So what did you kind of mean by that?
Yeah, well, I really have trouble just looking at the kind of 20% drawdown rule, because 20% is arbitrary. And what do you define that environment between 0 and 20% down? So it's useful for historians. It's not useful when we're actually having to operate a market. I think a better alternative would be to look at something like our net new high advanced decline line, which interestingly peaked back in November and up until this past week had actually been moving lower. And there we're just looking every day at the number of new highs on the NYSE plus NASDAQ and subtracting out the number of new lows on the NYSE plus NASDAQ. If that cumulative line is moving higher, that's a bull market. If that cumulative line is moving lower, that's a bear market. That's the way I think about it. I let other people worry about their 15s and 20s and 25%.
Yeah, and I know you kind of take a weight of the evidence approach, and you do this thing called the what is it? The bull market checklist, right?
Yep.
And it's basically just a list of things that you want to see to confirm that we really are in a new bull market. So I'm wondering if you could just kind of talk about some of those inputs and where are we at on that bull market checklist?
Yeah, sure. So these are the types of indicators beyond just pure price action at the index level that gives a sense to where we are relative to a bull market or a bear market. But I think more importantly, if we see rallies, are they likely to be sustainable? And a couple of them deal directly with new highs. We have weekly new highs versus new lows. Our net new high advanced decline line is in there. We have like to see volume expand. That was actually in this current environment. That was the first thing we saw in mid-July. We saw that those upside volume thrusts on the NYSE. We got two of them without having a downside day. So that was encouraging. End of July, we saw a breadth thrust. First one that we've had since June of 2020 in terms of a spike in the percentage of S&P 500 stocks at new 20-day highs. The one remaining outlier is at the bottom there. That's our risk on, risk off indicator, and some context around that. That takes a full year look at the relationship between different pairs of risk on and risk off assets. So it's by design going to be the slowest to move, so that the fact that it hasn't moved yet is not surprising. You look at shorter time periods with that risk on, risk off indicator. We have a short-term version, an intermediate term version. They are moving towards the risk on, but just in terms of the range in which these pairs of assets have traded over the past year, it's still tilted towards a risk off environment. But still, 4 out of 5 isn't bad. A week ago, we were at 2 out of 5. Mid-July, we were at 0 out of 5. So definitely some improvement over the past 6 weeks or so.
Yeah, I remember, I keep an eye on this one, and it seemed like for the longest time it was, no, 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 no. And we have seen, like you noted, a big change in character over the last few weeks. And you kind of noted it. One of the most bullish developments lately has been these breadth thrusts, plural, right? We've had kind of a cluster of them. It started with the spike in 20-day highs. I call that like the DeGraff thrust. I think he was the one that popularized it, Jeff DeGraff. And then last week we saw 90% of the S&P 500 stocks above their 50-day moving average, kind of another very bullish thrust. So we're in a bullish momentum or bullish breadth thrust regime, as I think you call it that. And I don't want to go down those rabbit holes too much, because we've covered some of those breadth thrusts a lot on the show and in the chart report. But you sent me this next one yesterday, and you said, if you're tired of hearing about breadth thrusts, I got one for you. Here's this momentum thrust. So could you just break us through this one?
Yeah, sure. So here we're not looking at the breadth of participation in the rally. That's what the breadth thrusts are. It's what percentage of some universe is doing this or is doing that. This just looks at price action on the S&P 500, looks at what it's done over the past 40 days. So momentum is in this instance is just a fancy way of saying rate of change. How, where is the S&P today versus where it was 40 days ago? And on Monday, we were 17% above where we were 40 days ago. So we eclipsed that 15% threshold. That seems like a breadth thrust to me. I was kind of watching it on the chart and went back and said, okay, that looks rare. Let's see how rare it is. Going back to 1950, you've got 20 some instances where you've gone from zero. So stocks have been flat on a 40-day basis to plus 15%. So that surge in momentum, you got 20 some instances, and most of them, not all of them, most of them have been higher, and in some cases significantly higher at, following, a year later. And so the idea here is we've had a tremendous rally off of those June lows, but the momentum that's emerged is not something we necessarily need to run away from. In fact, the data suggests, especially if you combine it with the breadth thrust data, it suggests that we should lean into that strength, and the emergence of both of those is strong evidence that we're not still in a 2008 type environment, if we ever were at all. But certainly the data is suggesting that's not the case at this point.
Yeah, and I think what's so interesting about this is it's really a great illustration of the concept of momentum. And we're all taught buy low, sell high. So why the heck would you want to buy after a massive 15% rally? Like it's like it's up too much, but the data shows that momentum tends to beget momentum, right? It tends to lead to further gains. That's the very definition of momentum.
Yeah, I think that's exactly right. Strength begets strength, and you can make some arguments about why that happens. We don't need to worry about that. The data is what it is, and so you can fear being late to a move, or you can embrace the strength that you've seen in the move. I think it makes more sense to buy high and sell higher, rather than worrying about whether or not momentum's all of a sudden going to evaporate. History says it doesn't.
Right. And again, we're looking at this in kind of the bigger picture context too, right? We tend to see these things towards the early innings of a new bull market cycle. It doesn't mean that the market has to continue higher in the short term. Maybe it does mean that it has to cool off a little bit, but ultimately move higher. But I want to move on to cycles and seasonality a little bit. JC shared this chart last week on the show, and he pointed out that we're kind of in that sweet spot of the cycle composite. And I'm wondering if you could just kind of break us or walk us through what some of the inputs are to this cycle composite.
Sure. It's just three inputs. It's looking at an annual cycle. So what the S&P 500 does over the course of any given year. It's the 4-year cycle called a presidential cycle. And there you say, what year are we in terms of the presidential cycle? And so all the year ones go in a column, all the year twos, all the year threes, all year fours. And then you have the decade-long cycle, a 10-year cycle, a decennial cycle, whatever you want. It's, what year are we? What number is the end of the year? So we're in year 2 of the 10-year cycle. We're in the midterm year of the presidential cycle, and we're in we're in August of the annual cycle. So it's basically just laying those on top of each other and coming up with a tendency that tends to persist over time. I think one of the important things that's noted on the chart, trend is more important than level. So we're not looking at the size of moves necessarily, but the direction of the moves. Are we at a spot where stocks tend to peak out, or like we are right now at a point where stocks start to turn higher after a period of consolidation?
Yeah. And so this next one I want to share, this one comes from Ned Davis Research. And you brought this one up to me a few weeks ago, and ever since I've called it one of my favorite charts because I really do think it speaks 1,000 words. I mean, you mentioned the presidential cycle was an input into that decennial cycle, and we're in kind of that sweet spot. And you see something similar here, right? Year 2 tends to be one of the weakest, especially towards like that third quarter, call it. And then you get year 3 tends to be really strong, that pre-election year, right? So I think you do a much better job of explaining this chart. But like I said, it's one of my favorite charts. And my mind was just mind blown when you brought it up to me. So what's going on here?
Yeah, so the top there that looks at what the Dow Jones Industrial Average has done over the course of a presidential cycle. You're right. You tend to have a low in heading into midterm elections, and then you tend to rally after that into the election year. And you can make an argument that, well, that's uncertainty surrounding the outcome of the election, those sorts of things. This chart, I think you look at the bottom and it makes a slightly more cynical argument that it's actually those movements are being driven by the liquidity that's present in the system via monetary policy, via fiscal policy. And the idea here is every politician likes to get reelected, and looked at from a presidential election cycle perspective. After a new president comes into office, they're not worried about getting reelected. They're just trying to, whatever their agenda is or whatever fires they need to put out, they're dealing with that. Sometime around midterm elections, they decide, hey, it'd be really great to get reelected. What can we do to enhance our chances of that? Well, increased liquidity is the lifeblood of the economy. It's the lifeblood of the market. It's the lifeblood for politicians. You see that playing out in the bottom pane here, where liquidity contracts over the first half of a presidential term, expands into the election year. It's pulling out the stops to get reelected. Stocks like it when politicians are pulling out all the stops to get reelected.
So basically, you're saying the presidential cycle and liquidity kind of go hand in hand. Whether it's liquidity driving the presidential cycle, I'm not sure. But I wanted to ask you, without getting into politics at all, I don't really pay attention to the news or headlines, but I have been seeing a lot of talk about this Inflation Relief Act or something. Is that something that could potentially be a form of that liquidity that you're talking about?
Yeah, I think that could be. You also have proposals to get away, like do away with student loan debt, things like that. Certainly, whatever, there's a political win aspect of it, but there's also just what can we do to get money to flow to areas of the market that are interested in us.
Yeah, and kind of stimulate the economy before that big election, right? So I want to move on to utilities next. This sector broke out to an all-time high. It was the first sector in this cycle to basically reach an all-time high. And it's a defensive sector. I'm wondering what you kind of make of the fact that utilities are leading. You pointed out yesterday that they just took the lead over the last 6 months, right? They're even beating energy now. So what do you make of that kind of defensive type leadership?
Yeah, that is one of the more puzzling developments in the market right now. They're strong. You can't argue with that. They're making new highs. They're up 20% over the past 6 months. Is that the type of thing you would expect to see if rates were going to keep going higher? Probably not. But it's not just utilities though. And defensive areas, utilities are in the lead, but things like staples are lagging. Utilities are in the lead, and right after them, industrials are there. So it's really this mixed message from the sector level in terms of what's going on. I think maybe the biggest takeaway is you've got a lot of investors that feel like they need to be involved in equities, but are looking for safe spots to hang out, and they're finding utilities, and then that goes back to momentum. Strength begets strength. Utilities start to strengthen, make new highs, and all of a sudden, utilities are a momentum play. I mean, maybe that's the story. They've been strong enough that now momentum players are picking up on them, and it's not a macro story.
I mean, listen, if you had told me last year that energy stocks would start to act as momentum stocks, I'm not sure I would have believed you. And that's certainly what we saw in the first half of the year. So, we got to wrap it up, and I want to end on sentiment. I know you do a ton of work on sentiment. So, after this 17% rally off the lows, nothing changes sentiment like price, right? What is kind of your read on sentiment right here? Do we have consensus in either direction?
We do have people talking from a sentiment perspective about this being an unloved rally. And you could look at the AAI data and say maybe they have a point. We're at, I think, 20 weeks in a row of more bears than bulls on the AAI data. So that suggests maybe investors aren't actually endorsing this rally. But at the same time, that same survey, the AAI survey, you've got the most bulls that you've had at any point this year, more bulls than you had when the S&P 500 was making new highs in January. So maybe it's not as unloved as some people would like to claim. Look at flow data, and equity ETFs are attracting inflows. So it might be from a individual investor perspective, and this I think has been the case for most of this year. What investors are doing and how they're positioned is a little bit different than the views they're expressing in some of the more popular sentiment polls.
Yeah, and you brought this other one, which I had never heard of, Consensus Inc. I guess they're another sentiment survey out there.
Yeah, so they're based, I think, in Missouri. They publish sentiment not just on stocks, but that's what's being shown here, but across a number of assets. Publish it weekly. It gets picked up in Barron's as well. And here we're looking at bullish sentiment for the equity market. And as we're talking about whether or not the rally is being endorsed or embraced or loved or hated, this survey, which tends to move pretty slowly, which is one of the reasons I like it. It also kind of flies below the radar. So that's another reason I like it. It just posted its largest 1 week increase in optimism in over a decade. The last time it had an increase of this magnitude, October of 2011. Interestingly, it's coming off of about the same level that it was back in October 2011. And from a price perspective, the S&P there was up strongly, continued to be strong as we moved into 2012. And so I'm not saying that history repeats, but it does rhyme. And this is setting up to be a similar sort of situation.
Wait, if I understand this correctly, is that like a sentiment thrust then? Like sentiment's normally counterintuitive, but you're saying that we saw the last time we saw, I guess this is the percentage change in sentiment, right? So it's not just looking at sentiment in its purest level, but you're saying basically when we've seen attitude shift that quickly before, it's kind of marked the end of, or the kind of, it's been bullish.
It has. And two things on that, Patrick. One, it takes bulls to have a bull market. And the most bullish part of the sentiment cycle as we move from optimism to pessimism to optimism to pessimism, the most bullish part of that cycle is after excessive pessimism, before extreme optimism. So moving from bearishness into bullishness, that's where most of the gains in the market are accumulated. That's what we're seeing right now.
Yeah, and I think it's interesting. Like, we saw historic levels of bearishness a couple months ago in June, right? Worst first half of the year for stocks since whatever, 1970 or something. And now the conversation after the 17% rally has I hear a lot of talk of people concerned that sentiment's gotten too frothy. Some of this stuff we've seen this week in meme stocks and stuff. I get it. It does look frothy. And 17% rally in a couple months, that's enough reason to automatically think that we need some softness here. But I think it's important to keep in mind where that recent change in sentiment's coming from. Historic levels of just massive bearishness, and that could probably take a long time to unwind, right?
Yeah, I think that's a good point. While we're seeing a sharp increase in optimism, it's off of excessive pessimism. And that's the chart we're talking about with the consensus data, the blue line on top. Yeah, it's well off of its lows and off of its lows quickly, but we're still at 40-some%. Not these readings into the 70s that we typically get as evidence of excessive optimism. So I think from a short to intermediate term perspective, we're outside of excessive pessimism now, but we're not yet at that point of extreme optimism.
I see. Well, Willie, you do some high quality work. You're not out there slinging, the hottest stock or meme stocks, whatever. You're more focused on the bigger picture stuff. And I think your work is more geared towards longer term investors, financial advisors, portfolio managers. So, if people are interested in your work, where could they find more of it?
Yeah, All Star Charts Plus. You can look us up. Follow me on Twitter at Willie Delwiche. Those are both great ways to get more better acquainted with what I'm doing and ultimately pay attention to the actual publications that we've got. You can also fire an email into info@allstarcharts.com. Express some interest there, and I'm sure someone will get back to you.
All right. Well, Willie, thank you so much for coming on the show, and I hope you have a great weekend.
Thanks a lot, Patrick. You too.
Thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe, and we'll see you again next week.